Early on this week, oil prices fell to their lowest levels this year, dragged down by fierce protest erupting across many major Chinese cities over strict COVID lockdown measures, hurting investor sentiment and the overall outlook stemming from China. However, prices quickly rebounded after oil inventories in the US reported larger than expected drawdowns. Now the attention of the market turns of the upcoming OPEC meeting on the December 4th and the finalization of the price cap proposal by G7 for Russian crude on Monday, the 5th of December. In this report, we aim to shed light on the catalyst driving WTI's price, assess its future outlook, and conclude with a technical analysis. Last week, we noted that Chinese government officials announced tighter restrictions as a response to surging COVID infection cases, and discontent among citizens was brewing below the surface. Earlier this week, mass protests erupted across major Chinese cities, scrunching the government's draconian measures, causing oil prices to fall sharply to their lowest levels this year. Not only civil unrest but also further declines in Chinese manufacturing activity darkened the demand outlook for the second-largest oil-consuming country in the world. Today, however, reports cited that Chinese officials signaled a softening stance against restrictions, refueling hopes for increased demand ahead from the nation. Should there be an easing of COVID restrictions, we may see oil prices receiving support, heading to higher ground. On another note, the US crude oil inventories pointed to an increase in oil demand during the past week, as the EIA yesterday reported an unexpected, oversized drop of minus 12.5 million barrels in US inventories, the largest drop since June of 2019, despite expectation for a drawdown of only minus 2.75 million barrels. Furthermore, the API weekly crude oil inventories figure reported on Tuesday also pointed to larger than expected drawdown, exceeding estimates by minus 7.8 million barrels for the same period. The expectation was minus 2.4 million barrels. The unexpected drop of inventories in both readings triggered reactions, contributing to the rebound of the commodities price from its yearly lows. On the 4th of December, OPEC Plus Council is scheduled to convene, and oil traders will be monitoring the market for any developments on the supply cut projections from the oil cartel. Earlier on this week, crude oil prices found support after the widespread protest across Chinese cities led markets to believe that the top oil exporting countries will intervene in the markets once again as the macro outlook from China worsens, causing significant downside risks on the global economic scene. That being said, some analysts believe that policy changes in response to the recent upheavals in China are not likely and expect the cartel to maintain its output quotas unchanged. On another note, the G7 group is expected to finalize the proposed price cap on Russian crude the following day, the 5th of December. And according to a report from Wall Street Journal released earlier today, the group proposed a cap of $60 per barrel to the 27 Eurozone member states and awaits for approval. The proposed cap is said to yield some negative responses from members such as Poland, which has declared in the past that the price should be set much lower. But it could potentially ease worries that Russia may retaliate by cutting supply should the price be set too low. Overall, investors will continue to monitor developments and assess incoming data leading to the announcements. Thank you for watching.